Hello and welcome to day 4 of my trading journal to help me learn ICT concepts. This time we're on the 6th of November. In the previous journal we were trading the Thursday, and I've decided to just skip the Friday. One reason because I've accidentally seen it now, so it's not going to be much of a fair back test since I can already see it, and also because while looking at these economic calendar events, I noticed we have a grey line here, and when we look at that, that's actually a non-farm payroll Friday, which according to ICT is basically a very volatile, unpredictable day to trade on. It would be for a beginner, it would be more akin to gambling if we were to trade a non-farm payroll. So I'm going to do the sensible thing and just skip that and go straight to Monday, as I haven't really had a chance to see what happens here. And also because just looking at this, it looks like it's going to be more easy for us to do our normal checklist for trying to determine daily bias. So let's do what we did last time in the first episode, which is to mark out the PM session high and lows. So that'll be the low that got created in the PM session, which I guess would be this candle here, wouldn't it? And it's as you can see, it's also created these other lows here, so these are sort of relatively equal lows. So ideally it would be really nice if price came down here below the midnight opening price, which would allow us to actually get in a trade this time. I might consider, if we have all the other entry requirements, I might consider entering once the London session lows have been broken, because we've got a very clean line here where we can see equal lows. So that really does look like liquidity. But we'll just have to see what happens, and of course the opposite could also happen as well. Price could ignore that and go straight after the PM session highs, which have also created equal highs after the London session here. So we've got all of this stuff which we can now use. And we're going to be waiting to see if we get a Judas swing below an equal low or above equal highs. So let's start going forward into the morning session. And yeah, we're just going to wait to see which area of liquidity gets taken first. Okay, interesting. We've had what looks like a sweep on liquidity for the equal highs. So that's a little bit unexpected. So we'll just switch to the sell conditions then. And let's say sell side liquidity has been taken. So we've got all of this that was taken here. So go ahead and type that up. Okay, next we're going to want a market structure shift, which could also occur before this liquidity. So we don't always have to. We can go back and see if there's been a valid market structure shift, as well as waiting for one to occur. So close above an old high. So a close above an old high. I guess it could be this here, and then a wick below a swing low. So I mean, I guess we could say this was the high. This was coming below a swing low here. not really super obvious, so I'm actually going to wait to see if we create a swing low below one of the recent lows here, rather than looking back, trying to find something that actually stands out. So we need it to wick below a swing low. So I guess that would be our last swing low here. This is definitely looking like either a price rally or a Judas swing. So we're not really sure which one it is yet. Okay. I need to see it wick below here for it to be an actual market structure shift. So see if that happens. Okay, so yeah, I would say that would be our market structure shift here. It's actually really difficult when you don't know what's going to happen. Like, it's all well and good watching a perfect example that's been laid out to you, but when you genuinely don't know what's going to happen, it's actually very difficult. Let's go forward a bit more. Okay, so next we need a fair value gap at a bearish order block. Fair value gap at a bearish order block. I mean, this here looks like it's our fair value gap. Let's try and find the order block here. So a significant high is broken. So the last significant high that was broken would be this market structure shift here. Sorry, was this a significant high has been broken here? Yes. Then bullish candles prior to a price drop that creates a fair value gap. So that would be the open of the last bullish candle prior to a price drop that creates displacement, aka fair value gaps. So we'll put that down as fair value gap with a order block. Next we need the entry to be within a premium, and in order to find the premium and discount, we need to do a fib from the most recent high to the market structure shift low. The most recent high to the market structure shift low, assuming you know, this leg in price is over and it starts going back up towards that fair value gap. Okay, so yeah, the fair value gap is within our discount Why is that not putting text in there? Okay, it is. It's just too small. Finally, the price is above the New York Open, which it is here. So that's actually met all of the conditions, and now we're going to put a short position in here at the fair value gap. we're going to see if this order gets filled, and we're also going to see if we get stopped out. Okay, let's see what happens. Okay, so prices, it hasn't actually filled us at that area, and it's okay, it's come down again, wicked below that, so that's still a market structure shift. And it looks like our thesis behind this trade might not have been accurate. I'd rather not get filled than get filled and then get stopped out. But if price keeps coming down here like this, this is actually starting to head towards our equal lows of the London session. So we might actually be abandoning this whole trade setup now, and once if it does get below here, then we would be looking for maybe a reversal or a rally in the PM session. Just trying to decide whether or not we should keep this order on the chart here, because we've now I'm pretty confident that this is our liquidity here, so let's just see what happens. Okay, and prices entered us into the trade and immediately stopped us out within one candle, so that's actually a loss for that trade there. So it seems like we might have misinterpreted the direction the market was going in here. Looks like, you know, possibly this might have been a liquidity sweep instead. But at the time it did seem to meet all of our conditions, so I guess we're just going to move to the sidelines now. That's the important thing, because we just had a loss. You know, our theory has been proven incorrect. We're now out of the morning session. And we seem to, if we look at this now, it kind of looks more like we're in a bit of a range bound market, very sort of choppy. Obviously I would like to see price go down there, because at least, you know, it would sort of validate the setup, and it would just be that we you know, didn't have a large enough risk parameter. Let's just kind of go forward until we get to the actual PM session, which is where we would then be looking for right. Okay, so we're in the PM session now. So I don't feel too bad about this, because, you know, we followed all of our rules. We entered the trade. To be fair, I have a very, very tight stop loss, and ICT himself says that the minimum area that your stop loss should be you know, at the candle body here of the candle. So okay, so we've got this fair value gap, we've got the 3 candles here. ICT in his 22 model says that the stop loss should be here at the very minimum, but to be safe should actually be above the high here. So you know, ICT's concept here has actually worked, you know, very accurately. It's my own spin coming in with this very ambitious tight stop loss that has sort of sabotaged the trade. So if you did decide you're more comfortable with some risk, going with what ICT recommends that the stop should be, then we would have actually had a very profitable trade. So it's a nice learning experience. Once these PM session lows have been taken, that's looks like the liquidity sweep. So might be a better idea to sort of just, once that liquidity gets taken and then price starts reversing, to actually close the trade if it looks like maybe it's starting to go against us. Okay, so still validating the concepts. It's just maybe I might need to do some tweaking to my risk parameters here, but that's fine. So now we're back to our original theory, which was that if price came down and took out these PM session lows, maybe we could start looking for long positions. So let's do that. We can start this process all over again. We have buy side liquidity taken. Next we need a market structure shift. So in order to get the market structure shift, we would need price to wick above the last swing high. So it might create a swing high, come back down, and then go above it. So that was the sweep on liquidity. This is our last, most recent swing high here. So we need price to go above there to show that it's actually, a valid reversal. Okay, well that's what we get there. A market structure shift. Next we need a fair value gap within an order block. So let's see if we can find a fair value gap here, or an inversion fair value gap. Okay, well we've got one here. Let's validate that with an actual order block. Some order block needs a significant low to be broken, which I guess would be this low here. And then the last series of down close candles prior to price rally. Prior to a price rally. So if this becomes a rally, this will hopefully validate the open of this candle, which is the order block, which is right next to the fair value gap. Near an order block. Then we need an entry to be within a discount, and that would be fib. See, there's a lot of stuff to remember. Fib from the most recent low to market structure shift high. Once we've confirmed that is actually a swing high, we need price to actually sort of come back down. And it looks as though the entry for this is looking quite unlikely right now. It looks like waiting for all of these signs. Doesn't look like we're going to get in a trade before 4 here, so we might just have to sort of walk away on a loss. Might have to come back tomorrow with a fresh perspective. So the idea would be, if price came back down into here, to be honest, what I was hoping to see is that this would be a market structure shift, then price would come back down into this fair value gap, and then do the rally. But this is the realistic nature of trading, is that you don't always get the entry that you want. So yes, obviously it's unfortunate that we had that loss here. Got stopped out by, that was our stop loss, 12 pips. The price went up to, so we got stopped out by 1.5 pips here. So maybe having a a stop loss that's always set in stone, that doesn't take into account, you know, the range of the candles. Maybe that might be something we'd have to look at changing. But yeah, I think this was a pretty educational, realistic look. We're not just cherry picking trades that all worked out. We had a loss, and then we didn't get all of our entry requirements in time. So yeah, that's a pretty realistic journal. Yeah, thanks for watching, and let me know if you have any questions. Okay, thanks, bye.